All right, hello everyone. Unfortunately, I'm not in a very good mood because I'm concerned about what is going on. We could be really not even kidding, not exaggerating, like on the verge of World War III here. Now, I've spent a lot of time in my life thinking about, gee, should I do my job as a trader if these bad things are going on in the world? And I was in Manhattan on 9/11, and unfortunately, a lot of friends of mine uh, passed away that day. And a lot of people in the trading community all kind of thought, you know what? If we stop doing our job, that means the terrorists win. So we're not going to stop doing our job. We're just going to keep doing what we got to do, and that's it. So that's my little, I don't know, soliloquy or preamble there. But anyway, let me get right into it. So here we go. U.S. warship and bases in Syria come under attack. So basically, they're like, all right, we don't care about the United States anymore. You guys don't scare us. We're going to go attack a warship. So bases in Syria and Iraq came under drone attack. I saw before that the ship that got attacked by drones, or there was like 20 drones. I mean, we got Pal here saying, all right, well, I don't know what's going on. We're not going to raise rates, but if the economy raises rates or if the economy expands, we're going to raise rates, blah, 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 blah. So once again, he confuses people with his profound sense of not knowing WTF question mark to do. So, all right, now let's look at the market. And before I'm done, we're going to talk about ways to make money if the stock market actually goes down. And believe it or not, it's not that hard to do. Uh, it's almost easier to do than when the market goes up because markets go down faster than they go up. So here's our 10-year treasury yield. And basically, we're at 5%, which is a huge psychological level. Higher interest rates are bad for markets and for equity markets. And the main reason is, well, every company that there is, well, every big company, they have to rely on short term borrowing to pay their operational costs or day to day expenses. They don't take money out of the cash register to pay people. So they have to borrow money. So if yields move higher, guess what? It costs them more money. It costs them more to borrow that money, and that takes their profit down right out of the bottom line. Also, a lot of the big funds that use leverage, leverage is just borrowed money. So it's the same thing. If interest rates go higher, it costs more money to get leverage. So that'll make some of the bigger funds back off a little bit. But look at this. So I mean, this thing is, basically we're at 5%. I thought it would take a few weeks to get 5%, but here we are. All right, let's take a look at the S&P. We're going to look at the SPY, the ETF that follows the S&P 500, and we see some very weak action. We've seen it for a while. This is not a surprise to those of you who are subscribers because we've been talking about this. People say to me, like, gee, Mark, how is it that you make these great market calls and you always seem to know what's going on and blah, 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 blah? Was it because you worked at some great hedge fund? Well, guess what? I did work at a couple great hedge funds. But if you watch this stuff every day, you start to get a feeling. It wasn't surprising that the S&P got to 436 and sold off. Why? Well, guess what? It was a resistance level for a while. What's resistance? A large group of sellers. And when the sellers notice that the price isn't moving any higher, some of these sellers start to be like, all right, there are other sellers coming into the market here? So I don't want to miss out because the buyers are going to go to whoever's willing to sell the lowest price. So I'm going to reduce the price I'm willing to sell it. So they start undercutting each other. So that's usually the case. And we can see it here. But a big part of this move, too, I think, is there's probably some real institutional movement in money because of just what's going on. Oh, also, I saw another thing on the Wall Street Journal here. I'm not going to spend too much time looking for it if I can't find it. But oh yeah, here we go. A financial crisis in China is no longer unthinkable. Gee, that that like really, wow, that's like something else to add to the puzzle here. Okay, let's talk about some potential trading ideas. Now, if the market's going to go down and you are not an options trader, do not fear. Okay, there are ways you can make money when the market goes down, and in my opinion, it's almost easier to make money when the market goes down than when it goes up, because it goes down faster than it goes up. So here's the S&P 500, which we just looked at. This is the main benchmark in the market. Most important thing to watch is what most funds base their performance on. This is a pretty nasty sell-off. There's going to be a little bit. I think we're going to get some follow through, and we're probably going to get down to around here and bounce. Now, why would we bounce at a level that was support? Well, levels that were support tend to become support again. That's because there are people that sold here that regret their decision to sell when the market rallies. They tell themselves, gee, if this ever gets back to the price I sold at, I'm going to buy my shares back. So this is why we get support at former support levels, because of remorseful sellers. But in the meantime, eventually, if we ultimately go lower, which I think we will, let's talk about some of these ETFs. Now, this is the S&P 500, right? There's this ETF here. The symbol is SH. And this is an ETF that goes in the opposite direction of the S&P 500. Very simple. Just like buying a regular stock or a regular ETF. It's the same tax consequences. You don't have to worry about what's going on behind the scenes. I mean, check it out, right? So today, the S&P was up 90 basis points. Which means the S&P was down 90 basis points. So if you think the market's going to go down, you could buy something like this SH. And you don't even need to be like an incredible super duper trader. Say you have a big portfolio of equities, and you have some profits on some of them, but for whatever reason, you think the market's going lower, but you don't want to sell for whatever reason. Most of the time it's because of taxes. Well, you know what you can do if you think the market's going to go lower and you don't want to sell your stocks, or it's impractical to sell your stocks? Well, you could buy something like this and add it to your portfolio and get a hedge. In other words, if your portfolio is down X percent, something like this might go up X percent and you end up break even. So this can be used as a hedge as well. The other thing that's going to happen if we really get going in the Middle East over there, and unfortunately, in my opinion, and I hope I'm wrong, it doesn't come to that. But anyway, we can look for oil to really kind of spike higher here. Now, oil has followed our market principles we talk about. Here's our psychology. Notice how there was resistance here and it became resistance again. Resistance here, resistance here, resistance here. How is it possible that a level that was resistance can become resistance again? Well, it has to do with psychology. There are people who bought back here who regret their decision to do so when the price goes lower. And they say, gee, if we get back up to 93, I'm going to sell my contracts. You have remorseful buyers placing sell orders at the level that was resistance. Same thing happened here. Now, why would support become resistance? Remorseful buyers buy here, price goes lower. A lot of them tell themselves, hey, if it gets back to my level, I'm going to sell. So if you have enough remorseful buyers placing sell orders at the level that was support, you can convert into resistance. And now, one more thing before I go here. Actually, two more things. Why would resistance turn into support? Remorseful sellers. People sell. Eventually, the price goes higher, and a lot of the people that sold thought to themselves, I made a mistake. If I can buy my, in this case, oil back, I will. If I can get it for the same price I sold it at. Market comes back. Remorseful sellers buying. What was resistance turns into support. Why would support stay intact for an extended period of time? Support. Seller's remorse. Investors sell. Price goes higher. They tell themselves, hey, if I can, I'm going to buy my shares back, or in this case, oil. If I get them at the same price I sold them at. You got remorseful sellers placing buy orders at the level that was support. If there's enough, support stays intact like this. So remember, everyone, psychology determines what levels are important. If you don't understand how important psychology is to trading, well, you know what? My advice is don't trade, because you'll never learn how to do it correctly if you don't understand how important psychology is. Okay, everyone, thank you so much, and I will see you soon.